Welcome back to the Financial Shepherd Podcast. My name is Joshua Casey Garland, certified financial planner, owner of Shepherd Wealth Management, back in the studio. I guess we got a lot to talk about today, Ez. But before we do you guys have a good weekend, Halloween, all that fun stuff?
Yeah, pretty good. Pretty good. How about you? How was trick-or-treating?
Oh, man, we got
Spider-Man.
We got more candy than what we started with, which is a hard thing in my house because my in-laws, we're over there handing out candy as we're taking our 4-year-old daughter, trick-or-treating.
Yeah.
And she got a bucket full of candy, of course. She wouldn't stop trick-or-treating until it was completely overflowing, which is great. I mean, I'm happy for her. She had a great time. She was dressed as Spider-Man. She had a good time with all her friends. But then my in-laws did not give away all the candy that we had in this massive bucket. So I ended up with more candy than what we will ever need. So trying to figure out what to do with that other than me eating it. That's the issue.
You didn't bring any of that in the office this morning. I don't see any candy in here.
So. No, I don't know exactly what we're doing to do with it, but we're going to figure it out. But yeah, I guess there's been some news recently from a financial perspective that we should probably talk about today, right?
Yeah, I feel like something happened.
I can't quite put my finger on it, but it feels like the same thing that's been going on all year long.
Oh, right. It's just more of that.
Yeah, just these Fed interest rate hikes at massive clips and causing the stock market to yet again have a very difficult day. And I think that's probably where we're going to spend most of our time.
Well, yeah. I mean, it's been a festival of pain all year, so why get out of it now? We bought the tickets. We're using them.
We're staying till the end of the fourth
I'm
quarter.
I'm going to see this bucket of candy full.
We are not leaving early.
Yeah.
So in all seriousness, this is the Financial Shepherd Podcast. Why we do these shows is simply because we are investors and we are also human beings. That's what the market is made of, a whole bunch of human beings. And they're trying to figure out how to make decisions with their money as it relates to all the things that are going around, not just here in the United States, from an earnings standpoint, from a monetary and fiscal policy standpoint, but also what's going on globally. And the news does a great job of playing into human beings' emotions. And we're all hardwired with fear and greed. Thanks to behavioral finance, we do know that humans feel losses twice as much as we feel good about our gains. And the news is really great at playing into that. That is their job. I'm not saying anything negative about the news. That's what they're there to do, and they do it extremely well. The one thing I think that they could do a lot better of for the general public so that we don't play into our emotional desires when it comes to making financial decisions is provide some historical context. And that's exactly what we're here to do, is say, yes, this is in fact what's going on. Here is the hard data, but also here's what history has to say about similar events. Therefore, you can plan accordingly over the next 6-12 months. So that's why we are doing this show, is to provide you with all the information that you're going to need to help make better and more prudent financial decisions. So yesterday, the Federal Reserve had another Super Bowl type of event. 2:30, Jerome Powell comes out. The market was basically flat, and he caused the market to basically sell off in a very, very hard way. The NASDAQ down over 3%. S&P 500 was down nearly 3%, and the Dow Jones was down as well. And this is on the back of an amazing October, and on the back of some really good earnings. So before we even get into all this stuff with the Fed,
All right.
I have to send out a monthly newsletter. Not have to, I choose to send out a monthly newsletter to all clients, just kind of letting them know what happened the previous month, why it happened, what history has to say about similar events, and therefore now we can start to plan for the remainder of this year and the beginning part of next year.
Yeah.
Right. So that's why we do the monthly newsletters for all clients. First things first, earnings. We are still in the middle of earnings season. 365 companies have reported thus far. That's 73% of the S&P 500. Overall earnings results are beating estimates by a median of 6%, and 70% of those reporting have been beating estimates. That's on the earnings per share perspective. So that's about in line with what historical averages are as far as earnings per share beats in the S&P 500, even though we're in the face of 40-year high inflation, war, supply chain issues. I can go on and on. On the top line, overall results are beating estimates for revenue by a median of 4% for those that have already reported, which is, again, 70% of those reporting have been beating top-line revenue estimates. So, again, pretty strong results. Now, we'll talk about the month of October. The Dow Jones Industrial Average booked a monthly gain of 14%, its biggest October performance since January of 1976. So it's a great month for October. And I've been calling for that all year long.
Yeah.
Right? We've been saying bear markets last on average about 9.5 months. We made it to month 10. And based on history, that's why I had made that statement. It's not because I have this crystal ball. It's just simply because I know that human beings haven't changed in freaking 2,000 years. Right? That's why we tend to have this bear market about every 4 years. Well, 2019, double-digit returns, 20, double-digit returns, 21, double-digit returns. This is year 4, right? Well, not too surprised it's happening during the midterm election year either. S&P 500 during the month of October was up 8%. NASDAQ was up just shy of 4%. So it was what everyone was hoping for, what I was expecting to be the bear killer. Typically happens in the month of October. Why? Is because September historically is the worst month for investors. And there's no real good rhyme or reason for that other than the fact, like we talked about in a previous newsletter for clients, is that the month of September is kind of a dry month from a news standpoint. There's no earnings announcements. The Fed's not meeting. It's just a month of purgatory for investors to think about all the stuff that they could be worried about.
Yeah, right on. Hit that wall of worry running.
They definitely hit it in September. And then October was that bear killer month, and it was great. I was very, very happy, obviously. Something that I've been calling for all year long actually happened, which was great, made me feel good. And coming into this Federal Reserve announcement, which was yesterday at 2:30, everybody had all the negative reasons already laid out, like inflation's too high, Fed's going to keep raising rates, Europe's going into a recession, we got this China COVID zero policy that's kept the whole country shut down. Are they going to change and pivot from that direction sometime early next year? Earnings are still coming out. We still got a conflict over in Ukraine. It's like all the bad news, in my opinion, had already been baked into the market because the market's forward-looking, looking out 9, 12 months based on what it knows has already happened and what they kind of expect to happen from an earnings standpoint, so on and so forth. So the market had expected a potential Fed pause. And what I mean by that is they expected the 75 basis point increase that we got yesterday. That was not the reason why the market came down. They were expecting Fed Jerome Powell to come out and say, hey, we've raised rates historically faster than any other time in history. And that's what I told you up front. He said, I'm going to front load rates, right? When they started out with 25 basis points, then they jumped to 50 basis points, and then it was four consecutive 75s, which, by the way, 75 basis point increase from a Fed funds perspective is astronomically high relative to any time in history other than 1980s when we had the worst inflation in this country's history.
Right.
So that was not the reason why the market sold off so hard when he made that announcement of, hey, we're going to increase by another 75. The reason why the market took off to the downside was because he said it's way too early to consider pausing or looking around to see how all these interest rate increases are impacting the real economy. That is the reason why the market sold off so hard, is because they're expecting him to say, hey, guys, we did our job. The markets are all down more than 20%. S&P, Russell, NASDAQ, whatever. Europe is in a mess from their stock market perspective and similar financial issues that they're dealing with fighting inflation. All these things that we already know. He said, hey, it's way too early to begin to consider pausing. What he went on to further say when he was asked questions is, hey, Mr. Powell, there's this lag effect, right? 12, 18 months after increasing rates this much. Like, how do you see that? You could have had a drinking game with how many times the guy said, well, we really don't know, right? Well, we have all these thoughts and ideas, and we model all this stuff, but at the end of the day, we really don't know. But what he went on to say is that, what we can do is we got to make sure we squash inflation, right? We let the genie out of the bottle, and we have to get inflation back under control, which is what everybody wants. Yeah. Because we want, when I'm 70 years old and I'm in my retirement years, I would like my money to have the same sort of purchasing power that it does today, right?
That's it. Yeah. If not getting better, then at least the same.
Nobody is mad at him for wanting to get inflation under control, right? Here's where I have some issues.
Okay, let's hear it.
We're going to air out these grievances here today. So what we went on to say is, hey, you know what? We're going to keep raising rates because the CPI data that we keep getting is way too hot, and the labor market jobs are super strong. And that's telling me that I can continue to ratchet up interest rates because the labor market's so strong and we have 50-year low unemployment rate, right? So he feels like the market can handle that. But what he also went on to say is that if we tend to tighten too much, because that was another question, like, hey, do you feel like you're tightening too much with all these interest rate increases? He said no. But he went on to say is that if we do happen to over-tighten, then we can always loosen the reins and start cutting rates. Well, here's where I have some issues.
Okay.
Right now we're going to start to air out some grievances.
You get your hammer and a nail. You can nail this to the door of the Fed.
Oh, man. Here we go.
Martin Luther style.
That's right.
Head to Jackson Hole.
Yeah. So first of all, why did we get here? Let's take a step back. We had a global pandemic. There's no playbook for how to handle that from a monetary policy standpoint.
Right.
So they printed money to keep the world from just completely collapsing from an economic standpoint.
Right.
The issue that I have is $9 trillion worth of printed money. Again, the most money that's ever printed in the history of mankind. They came out and said 18 months later, after a whole bunch of economists, Jeremy Siegel and others were saying, hey, this is going to cause some serious inflation issues, right? You can't print this much money and not have something like that happen about 18 months later. Obviously, those folks were 100% right and the Fed was wrong because they blamed the inflation issue primarily on supply chain dislocations, which I admit I bought that, right? Because it made complete sense to me. Like, you shut down the whole global economy. This is a very complex global economy, logistics, all this stuff. And to just turn it back on and expect everything to just go humming along like it used to prior to shutting down the whole world, was unrealistic.
Yeah.
So I totally bought the supply chain dislocation because it was true. And it is impacting inflation to a degree today. But the truth of the matter is the real carry in the coal mine, if you will, was the fact that we printed more money than we've ever printed in the history of mankind. That's truly what caused inflation. Supply didn't help, but that's now no longer, in my opinion, a true issue.
Yeah. Okay.
Other than the fact that China still shut down. So yes, there is still some supply chain problems, but nothing like what it was when we first let everybody outside of their doors again, right? So printing that money was the real issue of inflation. And the Fed called it transitory. So they were wrong about that, right? It's obvious that they're wrong. It's so obvious that they're wrong. They were still buying mortgage-backed securities in March of this year, right? 2022.
Yeah.
And then they said, oh, shoot, we messed up. You know what, guys? This was not transitory, and we did print too much money, and we gave away a lot of money to business owners and families. So now we got to do something about this and get the genie back in the bottle, which is extremely hard to do. I don't know if anybody's ever squeezed out some toothpaste and tried to put it back in their bottle before.
I have not, but I have tried to put a genie back. It's almost impossible.
That was a weird Halloween.
It was a weird July.
Well, this is a weird market year. So, all right. So that's the first problem, right? They printed a lot of money. They did what they had to do, but then they blamed it on supply chain and admitted they were wrong. So wrong that we actually had to increase interest rates at the fastest clip we've ever increased them in the history of mankind. And like I said yesterday, when he's asked all these questions about how do you think about the impact that interest rates will have, this lag effect in the real economy. Like, yes, we know it's a thing, but we really don't know what the real impact is because we've never raised rates like this before.
Yeah.
But to go on and say that we can always, hey, if we break something, whenever we hit this wall,
super glue,
no problem. We'll just start to rail this thing back.
Yeah.
Well, how about the opposite of that is also true? How about you say, you know what, inflation is still a problem. It's evident in the numbers that we're seeing here. We also do understand that we've increased rates faster than any time in history. And we will need to continue to increase rates, 75 basis points here in November. We'll probably need to increase rates a little bit more in December. But because we know that there is this lag effect, we're going to maybe just go into 2023 with this idea of let's see what the actual economic impact is of raising all of these rates. And by the way, if we go through a few quarters and nothing's getting better, we can actually keep increasing interest rates.
Yeah.
There's the other end of that exact same statement. maybe Jerome Powell, and I got to eat this, right? I bought the transitory thing. That was wrong. I put a lot of faith in the fact that these individuals, they can contact any central banker they want to on the planet. They can call any CEO and they'll answer. They'll have lunch with them. That these people truly do have their finger on the pulse of everything that's going on around the globe from an economic standpoint. I put way too much faith in this Federal Reserve board, if you will. They were just flat out slap wrong, and now they're acting like a bunch of tough guys and gals that are going to come in here and squash inflation and be the heroes, for the U.S. economy. That is not it at all. They've been a big pouring of gasoline on a fire that started when the global pandemic actually happened. And they're not getting any help from, Congress or the White House either, by the way, because let's just be, very frank about this, since we're airing out grievances today. The Fed messed up, right? There's another solution to, let's just see how fast we can run this thing into a wall.
Yeah.
That I don't know. It makes a lot of sense to me to maybe just say, hey, let's look around. We have brakes on this thing, and we also have an accelerator. We can keep increasing rates or decreasing rates whenever we want to.
Yeah, I mean, it totally is. Why use the brakes when we got airbags? That's exactly what they're doing.
That's the best metaphor. I was looking for one.
Slow this car down. We got airbags. Driver's side and passenger. You'll be fine.
Yeah, that's not the case. I'll talk about how we're handling this from a positioning standpoint here in just a little bit. So the Fed's been flat out wrong. So maybe Jerome Powell is the wrong guy for the job. He's not the price stability guy, right? Why would we be rooting, right? You got two mandates in the Federal Reserve: price stability, inflation, and maximum employment. Maximum employment, they define that as a lower unemployment rate, 4% or lower.
Yeah.
Ideal.
Well, he walked into that.
Walked into it, now we still got it.
Yeah.
Why in the world would we be rooting? I mean, the guy's literally rooting for people to lose their job. He needs like 2 million people to lose their job. He needs 2 million people to lose their job so that they stop buying things and so that inflation can come down and they can declare victory and look like some heroes. That is the most un-American thing. We should never be rooting for people to lose their job. But he can only affect, from an economic standpoint, and they admit this, he can only affect demand, right? So how do you kill demand? You have the market go down, so people got less money next to their balance sheet because we had the most money that we've ever seen next to our name at the beginning or at the end of 2021.
Right.
That's true for probably pretty much everyone because of all the stimulus, the market performance for 3 straight years, et cetera, et cetera. So he wants your balances to come down, right? Although he'll admit that the consumer's balance sheet is as strong as it's ever been because, again, of all the stimulus and the increase in people's wages this year and all that stuff. So he wants the market to come down so you feel like you have less money to spend, and he wants people to lose their jobs so that they actually don't have a job and therefore no money to actually spend, which therefore brings down the demand. And demand and supply can become an equilibrium. That is the only tool that he has, and that's the interest rate increase.
And if we've already established that the supply isn't attached to
exactly.
it, why? Yeah.
Exactly. So he admits that a huge part of inflation is coming from the energy space. The housing space, I cannot believe that he's still standing on the fact that, owner's equivalent rent and all this other stuff from the housing market perspective, because housing is a huge weighting in how they calculate CPI, the inflation number.
Uh-huh.
I mean, it's so obvious. Why would a home builder want to go build a bunch of homes when mortgage rates are on 30 years over 7%? Right? It's not going to happen. That's not going to help the demand side. People still have demand to actually own a home. They're just not going to do it until interest rates come down. Okay? That owner's equivalent rent number, that's going to be sticky, but that actually is the slowest thing to actually show up in economic data. It's just like the used car data. Right? We talked about it on the Friday happy hour last week. The actual year-over-year price of used cars is down like 7%, but in their inflation calculation, they're showing it as positive 10%. That's a huge dislocation. It's called the lag effect. Yeah. Right? They know all this stuff. That's the only thing that the Fed can do is increase rates to squash demand. They can't do anything at all about the supply side of things. They cannot do anything. They cannot make energy companies produce more energy, pump more oil. They can't do anything about the price of things like natural gas and oil. That's based on a global economy. That's who makes the prices. They can't do a lot of things as it relates to the supply side of economics. They can do virtually none of those things.
Right.
Although that is something that fiscal policy can address. Right. We can address that. So the other issue that I have here is that you have the White House coming out yesterday and blaming all these oil companies and saying, hey, you guys are making too much money, therefore we want to impose a windfall tax, which isn't going to pass. And let's just be clear, it's not going to pass Congress. It's just not going to be something that actually happens. But my point being is that you cannot have fiscal policy pointing the finger at every other issue and blaming it on somebody else. Like it's their fault. It's the Federal Reserve's fault that they're not increasing interest rates fast enough. It's the oil companies' fault that they're not passing along these massive amounts of profits and reduced prices at the pump. First of all, nobody was coming out to help the energy space for 10 plus years when they couldn't make a dime, right? And all these oil companies, these refineries that had to consolidate, people were getting bought out, losing their jobs. It was the worst performing sector of the market for over a decade. And nobody came out to say, hey, I'd like to help out, all these folks are losing their job and so on and so forth from an energy perspective. And by the way, all these energy CEOs, if they had it their way, if they truly could, control price, therefore their profit, they would keep the price of oil fairly high, for sure above $65 a barrel, because they can mint money at that point.
I mean, and not to mention, factor in the fact that industry, like oil, is on its way down. I mean, it'll never be completely phased out in our lifetime, but I mean, like the reliance on fossil fuels is a major crutch that everyone is trying to get away from it. So
the right thing to do.
Why would you go make more oil when you're not, there's not going to be a market for it.
Right. And nobody's
I'm not trying to give them any kind of like props because,
right. And they don't know, the biggest risk that you have as an energy CEO is regulators. That is the biggest risk that you have. Now, obviously the writing is on the wall, as you just mentioned, we're switching over to electric and more efficiencies from a net zero
renewable,
carbon.
Solar, wind, those things are all coming.
All great stuff. And they're actually preparing for that, right? So ExxonMobil had an excellent documentary, which was on CNBC earlier this year, talking about how they're able to, basically pivot from just being, let's produce and refine all this oil and pump gas out. They can actually make a lot of profits in this new, environment that we're heading towards from an energy consumption standpoint, right? Getting out of fossil fuels into more energy efficient types of things. So really cool. I'm not going to get into that today. But my point being is that the White House should not be pointing the finger at, OPEC should be increasing production. All these oil companies are just being super greedy.
I mean, they are.
I mean, yes, but for 10 plus years, they made no money. There was like negative prices of oil, essentially. Now they're making money simply due to the fact that there is a geopolitical event going on and there is more demand than there is supply currently. And nobody's willing to increase supply because they're always very much concerned, rightfully so, about the political risk that's out there, right? When laws can get changed every couple of years if they wanted it to.
Right.
So that's a problem that I have as well. You have the White House basically pointing the finger at all these people and industries when they could just come out and say, and this is where leadership, this is what we're talking about, leadership here, right? We're not talking about necessary policy. We're talking about leadership. Instead of pointing the finger, because nobody feels like anybody's leading, right? It's just blaming a bunch of other industries, people, etc. Why not just say, standing right next to the Federal Reserve chairman, like, hey, we are two independent organizations, essentially. We got fiscal policy and we have monetary policy. Fiscal policy, we're going to do everything that we can to control demand because we screwed up. We screwed up. We thought it was transitory. It wasn't. We printed too much money. We were way behind on increasing interest rates. Now we're doing that, and we've done it so much so fast that I'd like to maybe take a little look around here and actually see what the true impact of economic data is, because I can always keep increasing interest rates. Right alongside the White House, from a monetary policy perspective, he could pat Jerome back, right on the back, give him a fist bump, whatever, and say, you know what? They're doing what they can do on the demand side. Obviously, we're going to get inflation back under control through what the Fed can do from an interest rate perspective, although we know it will take some time. And if we need to keep increasing rates, we'll keep doing that. If we get it come back down to where we want, great job, Fed Chair Jerome Powell. From a monetary side, because we know the Fed can only do so much on the demand side, here's what we're going to do. We're going to take a leadership role here, and be a little bit proactive. I don't know how long this is going to take to fix things on the supply side. But what we will do is we'll go ahead and start to make investments for the infrastructure of our grid. We'll make investments so that it's a little easier and less red tape for these energy companies to produce things, pipelines, refineries, whatever it is that they need, so that we don't have these supply problems. We can also make investments not just in the chip sector like we've already done. We can also come out and say, hey, food prices, obviously Americans feel that every time they go to the grocery store. Why don't we start making some investments into greenhouses and other more farm efficient ways to go about making crops and making sure that we don't have natural disasters wiping out X percentage of our the food industry that we're counting on here in this country, so that we don't have to count on other countries for wheat or corn or whatever the thing is. So let's go ahead and make investments now into greenhouses and other different things spread out across the country, so that we don't have to be energy dependent anymore. We don't have to be chip dependent anymore. We don't have to be agriculturally dependent on anybody anymore. I don't know how long that's going to take, but those are the types of things we're going to start investing in right now. Now you have demand and supply working in the same direction to solve the same problem that would impact every American, and for that matter, our allies around the world. Right? That is the way to go about handling it. That is leadership. Even though you're admitting that I have no clue how long this is going to take, but we're going to do what we need to do right now, so that by the time your grandkids are out of college, your kids are, in the workforce, that they won't have to experience the types of things that we're going to have to go through over the next couple of years.
Oh, that scenario that you just talked about, I think I've read that before. It's actually the plot of Avengers 3, Inflation War. I mean, it's awesome. I would love to see that kind of leadership, but in my entire life, never has anyone in those positions made it seem like they actually are working towards solving those types of forward-thinking issues and making life for average Americans better in that kind of partnership. I've never seen that.
No, you haven't.
To the point to where I can't even fantasize about a situation where that would go down, because when people have the possibility to look forward, what have we done?
Yeah, I mean, this has nothing to do. This is not a political show. I don't care who people vote for, because the reality is, from a market
perspective, for Powell's. We're talking about that.
I mean, it doesn't matter, Republican, Democrat, Independent, whether you like these people, you don't like them in the position. It doesn't matter. The market's average 10%, regardless of whatever party's in power here. What we're talking about is leadership. These people are put in a position. They were voted in by the general public. Powell was appointed, right? They have the ability to solve these things. I mean, literally, you can come out on the public on any news radio show and literally say, hey, I'm Jerome Powell, the Fed chairman, and I am the demand side of this equation.
Yeah, but
the White House can say, I am the supply side of this equation. This is how we're going to move together with the tools and resources that we have to solve the common problem that's affecting every American.
Yeah, again, that's an awesome fictional narrative. But I mean, when has that ever occurred? When do people especially in our lifetime, in that stage of it where the buck stops here, when does that accountability ever show up?
I always go back to the first thing I think of when I think about stuff like that. You're right. None of that's ever happened, which is why it would be so powerful, right?
Yeah.
It'd be super powerful. And,
I mean, that's what we all are lullabied to think is actually going on.
Well, it's something like that. It has to. I mean, we've seen leadership before, right? You go to Teddy Roosevelt, the man in the arena type of speech, right? You get all these Winston Churchill type of figures. There has been really strong leadership in this country in the past and in other countries as well.
I mean, if we're going to talk about, just to be fair, some of those things you're addressing, granted on a specific scale, were in the infrastructure bill that was attempted to be passed, the past 2 years. Mm-hmm. And it kept getting whittled down and whittled down. It was very much that foresight of, we need certain energies, we need certain infrastructures so that when the S hits the fan again, we don't have to go through what we just did.
Yeah.
And no one could even agree on that.
You're 100% right, Ez. It's just that is the most disappointing thing that I have to say about all this stuff that's going on. I mean, yes, I have no problem with the Fed increasing rates. That's what they need to do to help control the demand side, like we talked about, and get inflation under control. But they don't need to come out and act like a bunch of tough guys.
Yeah, that's just it. I mean,
like, hey, yeah, like you said earlier, we have airbags, and it's in the form of me cutting rates. So let me just run this thing as fast as I can into a wall, see how long that actually takes before I break everything.
Yeah.
And then I'll start to rope it back in. And then I'll declare victory saying, hey, guys, we got inflation under control. You know, you have 40% less wealth, but we got inflation under control.
I mean, 100%. And I'm totally with you on everything. You know, it would be awesome. It would be incredible if in one of the most dire moments, you know, I mean, granted, sorry, I shouldn't have even said that, but it'd be awesome if now is when we saw some true leadership. And I think the most off-putting thing for myself and a lot of other Americans who aren't, you know, CFPs like you, that aren't responsible for other people's money, just ourselves, is that things already seem so out of reach. Like they say all this money is there and inflation, but like all I'm seeing is like a hurt, right? Like I don't feel like I have more money than I ever did. I just feel like I can't afford anything.
Right.
So forgot my original point because
that's what the Fed wants.
But the thing that is most off-putting, like even I know the Fed has one thing they can do, which is control interest rates. That's it. But the thing that is the most off-putting to myself is the attitude, almost the hubris that we see when Powell talks. You know, we had the TV on in the studio before we started filming, and Kramer had a great point, which is that, you know, they release these statements which are just completely like, hey, here's what we think. And then hours later, day later, Powell contradicts everything.
Yeah. Like
there's
I said,
no acknowledgement to like, hey, I know we said this, but like we're getting new information as we see it. We're getting it. There's just there's no confidence I have in because of that attitude of like, what, you afraid to crash? You know, it's like,
no, I mean, the thing is like, and this has actually been reported. I don't know if it was in Barron's, probably Barron's, because that's what I read a lot. That Jerome Powell has this book written by Paul Volcker. For those that don't know who that is, that's the guy that took over the Fed chairman position during 1980-81 when we had the worst actual inflation problem in the history of the United States, and he jacked up rates to like 20%.
I thought he was the bad guy in Harry Potter.
Close. Resemblance there.
Different name. Okay.
But Powell has his book, Paul Volcker's book, on his desk. This is what the report was. And the title of Paul Volcker's book is Keep At It. Right? It's like, keep at it. Like, that's what Jerome Powell's mindset is right now, is he has already admitted that it wasn't transitory, that they're way behind in increasing interest rates. They should have did it a year ago. Now he's going to be, I think in his mind, he's like, I'm going to be the next Paul Volcker. Somebody's going to want to write a book and read it about how I squashed inflation. Like I was the hero.
And it's going to be called 1,000 squats before breakfast. Keep at it.
It is the wrong mentality. You are not the price stability guy anymore. In my mind, I've lost complete faith in what the Federal Reserve is willing to do. What they're basically doing right now with the market is trying to keep face. They're trying to hold credibility.
That's it.
It's
a PR stunt at this point.
And that is not what that's politics. That office of the Federal Reserve is completely agnostic from Republicans and Democrats. That's what the role is. This is a political play that they have going into a midterm election. Powell is a Democrat, and there is an issue from the Democratic side of the aisle as it relates to this midterm election of whether or not they're going to keep control. I mean, that's the truth of it, right? This is not a political show, but that's the actual facts of the matter here. And that is not the way that you should be making policy decisions.
Well, not only that, but that's the way it's always been done, or let's just keep doing it. Right. That's never a good reason to do anything.
My point is,
much
too,
less
like,
run the economy.
You could literally have had a drinking game watching that 2:30, public address announcement, because when he was asked questions, like real specific, deep questions about, hey, how do you think about lag effect and the historical pace of interest rate increases? You mentioned you wanted to front load it. Well, it's been 7 months of front loading. How much farther are we going here? He's like, I don't know. Like, you literally could have had a drinking game of the many times that he said, I don't actually know the answer to that.
Well,
which is the right answer.
Listening, you've heard it right now. Got a Joshua's own mouth. And next time Powell makes any kind of public announcement, we're going to be live drinking.
I hope it's on a Friday. That would be a heck of a happy hour right there.
That would be great. But we know it's going to be a Wednesday at 2.
Yeah. Well, With that being said, now that we've gotten all those grievances out here, what do you do? So I know we got a couple questions, but I wanted to share this information with the audience real quick. So this was in my most recent newsletter to clients. So we're talking about midterm elections here. So the midterm election that we're about to go through here, so post-midterm election periods, according to U.S. Bank, the S&P 500 has historically outperformed the market in the 12-month period after a midterm election with an average return of 16.3%. And this is especially true for 3-month periods following midterm elections. So really what we're talking about here is, in general, the best 6 months for the market is post-midterm election. And this has happened, so let's see, since World War II, there have been 18 midterm elections. After each one, U.S. stocks were higher 12 months later, every single one. That's 18 for 18, no matter how the ballot turned out in favor of Democrats or Republicans. That is what has happened. Now, obviously, past performance is no guarantee of future results for all you compliance folks out there watching and listening to this. Clearly, that is true. But again, the market is made up of human beings. And the one thing that we know about human beings, thanks to Warren Buffett, is that human beings don't learn from history.
No, and that is the basis for this podcast, as we talked about earlier.
Yes.
Talk about the historical.
Yes. So the Fed's doing, in my opinion, the wrong messaging. I don't disagree with the fact that they raised rates 75 basis points, and I wouldn't be too bummed out if they raised them another 50. I don't think 75 is necessary at all. But if the labor market still looks as good as it does, and it probably will, and I sure as heck hope it does, because I'm not going to be the guy that's going to root for people to lose their job.
Yeah.
They may do another 75 basis points in December, which would be a huge bummer. I think they probably might. I think he's closer to doing that now than ever in December. But that might give him a little bit of a pathway to say, hey, I might increase rates just 25 basis points in Q1. And then because we're over 5%.
And these airbags are working.
Yeah, and we're over 5%. Now I'll look around. Like, all right, we'll see what happens. That's what the 2-year note's telling you right now. 2-year note's over 4.7%.
Yeah. I
have some clients that I'm going to be putting into that shortly after this show.
I mean, we have a texter asking about that.
Oh, great. Well, we got time for it. Let's get to it.
Yeah. Oh, so Pooja, returning texter from Cincinnati, says 2-year note is looking real good. Is now a good time to take some of that on?
100%. So here's what we're doing. So the only performing sector that's had a positive performance this year in the S&P 500 is energy. We're going to stay overweight energy. We're going to stay overweight healthcare. Healthcare is the second largest sector in the S&P 500. And it's a way to play offense and defense in this kind of environment. As we talked about, if I go break my arm, I'm still going to my doctor to get that fixed. I don't care if we're in a recession or not, or whatever the Federal Reserve is going to do. What we're also going to be doing that's a little bit different than what we talked about in the past. And this decision was really made based on the announcement that the Fed chairman had yesterday. What we're going to do is allocate more towards an industry that is very much a bellwether in a recessionary type of environment. So think insurance. I have insurance both personally and from a business perspective. We all have insurance, our home, our cars, and on a business perspective, you might have key man insurance, you might have a buy-sell agreement going on there, all these other things, errors and omission insurance, we all have to have it, and that is not going to change whether or not we're in a recession or not. So you could actually go into the insurance space, either through the individual publicly traded companies, Allstates, etc. You can own a company like Berkshire Hathaway, which we already do, which obviously has a lot of exposure to the insurance industry. Or you can actually go out and buy an ETF that tracks some of the biggest players in that specific industry. And they all produce a very nice dividend yield. And again, the prices should be very stable regardless of what actually happens from both here in the United States side, whatever we do with interest rates, as well as whatever happens outside of the United States. So that's a new position that we're going to be holding for clients. Now, the other part is technology. And technology is going to take it on the nose here again today. I'm sitting here talking right now. Tech space is down 1.7%. It fell off a cliff yesterday after that announcement that the Fed chair had, basically saying, it wasn't the 75 basis point increase. It was the fact that he's still hell-bent on continuing on that path
right,
for an unknown specified period of time, even though we've already front-loaded for 7 months. So you guys tell me what front-loading really means then. I guess it means like 2 years worth of, what we're going through here. So that's what we're doing on a allocation standpoint, but we're also to the question, the 2-year is at 4.74% right now. So I have some clients that are in their retirement years, some that are very close to that, and it's been a poor decision. We have not been in bonds all year long. Bonds right now are down 17% year to date. The market, S&P, is down 22% year to date. Like we talked about that in our last podcast, that 60-40 allocation, how historically awful it is.
Yeah, we did.
So it's been a terrible place to be in fixed income this year, which is, again, very odd historically. You could generally expect a positive return in fixed income when the market's selling off. 2008 is a great example of that. You could have been up 20% in something like an intermediate government type of bond when the market was down 50. Like that's usually what you would expect. This year is not that case. But to answer the question, now that we are getting 4.7, in the 2-year, we should expect inflation to eventually come down. Like it's not going to stay at where it is today, right?
I hope.
It certainly will not. So now you can own an asset class that's backed by the full faith and credit of the United States, the safest investment out there, paying a solid 4.74% over 2 years guaranteed, right? Well, if inflation is going to come down, well, then you can actually look at that and say, I have a real positive return even after factoring in inflation, right?
Right.
Because those things, if you're holding that in a taxable account, is local and state tax exempt. You will pay federal tax on the interest. And if you're holding an IRA, you don't pay taxes at all.
Yeah.
So it's a great decision. We're actually taking some profits out of things like healthcare, energy, and other positions, Berkshire, Lockheed Martin, United Health, taking some of those dollars off the table and saying, hey, we're going to admit that we want to take some volatility out of our portfolio. And for a long-term growth investor, I'm suggesting maybe no more than 15% right now, because we don't want to just throw it in a 2-year, because we're also going to have some political changes happening between now and the next 2 years. So what we would rather do is we would rather take those profits off of those types of positions and ladder that out, because you can get nearly 4% on the 6-month Treasury note right now, right? You're going to get 3.5 to 4, depending on how that changes here today with the news that we got yesterday.
Okay.
So 6 months, you can get maybe 3.5, 4%, ladder out another 1 year, right? 1 year, you probably want to get 4.25, 4.5, and you can own that 2-year at 4.7. Now you have a laddered approach. And what does that do for you? Well, it takes out one of the biggest risks that individual bondholders have, or fixed income investors in general, is duration. How long is it going to take for that fixed income product to mature? And that's important because if rates continue to go up, well, you don't want that to be invested in a 5-10 year type of fixed income product. You'd want some of that cash coming due so you can take it and reapply it to a higher interest rate. Or if the market sells off and we actually do have this technical recession, I think we've had a recession all year long. We just can't call it that because of how tight the labor market is.
Right. We've talked about that on the show.
But if you have an actual true recession next year, both in Europe and here in the United States, well, now you have capital coming due. If you have that 6-month Treasury, right? Again, you get that guaranteed 4% for 6 months of holding that money there. And if we go through that recession, now it's capital that's coming due. You get to make a decision. Do I want to take all of this, some of this, and put it into equities now that they've sold off because of this recession? Or do I just go ahead and reapply that to my fixed income ladder, right? And go out another 6 months, and you're probably going to see a higher yield 6 months from now. That's what you're seeing today. If the Fed is hell-bent on killing inflation by increasing interest rates. So that's how we're doing it here at Shepherd Wealth Management for clients. What I would say, though, is just because the 2 years at 4.7 and climbing does not mean it's the appropriate investment for everybody. Like if you got some cash sitting around that you know for sure you're not going to need for 3 or 6 months, definitely consider owning something like a 3 to 6 month Treasury. You're going to get a nice, return on your investment there for just that short period of time. But I am going to be 36 in March of next year, right? One of my best friends is just turned 41 years old, as you're just 40 years old or something in that ballpark, right? Like for us in this age that we're in, it would be foolish for us to go ahead and allocate any capital towards fixed income, because the one thing that we know for sure is that equities will outperform fixed income over a lengthy period of time. Right. We have nothing but time before we're going to be in retirement type of years. Now, we're not promised tomorrow, but again, I'm not going to count on the end of the world. It only happens once, and if I bet on that, who would I collect from anyway?
Yeah, stocks aren't going to matter if that happens.
Exactly. It's not going to matter at all. But if we expect to be around 30, 40 years from now, we know for sure that equities will outperform fixed income. That's not even a debatable topic. So it would be foolish for us to allocate a significant percentage of our capital towards something like that. So I just want to make that clear. It's not a blanket just because 2 years paying 4.7 that everybody should go out and buy the 2 year, or everybody should go out and buy the 6 month treasury note. Like that doesn't jive with everybody's situation. So I just want to be clear on that. But it is an actual asset class that deserves some consideration at this point.
Right on. Well, you got room for another? Ready for another?
I can do this all day long, man.
All right,
Let's do one more.
We got a couple more good ones. Let's run through those. Tammy from Ohio says, "Is there any possibility of a soft landing?"
No.
All right, Brian from Shelbyville.
You know what? And the reason why is we already kind of talked about it. Like, the man is coming out and saying we screwed up, we were wrong about it, and I can keep increasing rates. And if I break something, then I'll just bring them back. So I don't think that that's what the Fed will ever come out and say, that we are going to break stuff so that we no longer have to increase rates. But that's basically what he said yesterday.
That is what he said. And the attitude, again, is the big thing. It's like those people on YouTube who get paid to have bugs bite them.
Right. And that's why I'm saying we got to rethink the game here a little bit. Like,
yes,
you need to be overweight energy. You need to be overweight healthcare. You need to be overweight defensive positions, like I mentioned, the insurance sector. And if you're looking for long-term growth, you still have to have exposure to tech, but you're owning all these other asset classes, healthcare, defensive, energy, and anticipating that you're going to make profits there so you can take those gains and allocate it towards tech as it falls. You're not going to pick the bottom, just like I haven't picked the bottom all year long. It's been painful to be in tech. But you cannot tell me that the next bull market, which on average lasts 3 years, tech's about 25% of the market. What are you going to have, a bull market the last 3 years with 25% of the market saying, you know what, I don't want to participate in that? No, it's not going to happen. Right. You cannot have a bull market unless technology plays a big role in that. So that's what we're doing, and that's what I think you should consider doing as well, without knowing all your situation. So take that with a grain of salt, but it makes some sense.
There is no possibility of a soft landing, Tammy. Unfortunately, we've passed that.
I would rather be pleasantly surprised and wake up one day and feeling like, oh man, we just landed softly.
Yeah,
but
I went to sleep on the tarmac and I woke up on another tarmac.
I think the soft landing is going to look more like one of those crash dummies that you see hitting an airbag going 70 miles an hour and all of a sudden you hit a brick wall. Like that's your soft landing, is that you only broke your nose, but you didn't die.
Yeah. You've still got to pay for it, but you're alive.
Yeah, your insurance premiums are going up, but sorry about that.
All right. Brian from Shelbyville, longtime texter. Brian, we appreciate you so much on this show. I have lost all faith in the Fed. Do you still find them credible? Well, we probably should have led off with that.
Yes. I think the message has been clear. I honestly, if I was in his seat, that is to me the only thing that you could possibly do at this point.
Powell's seat, not Brian in Shelbyville.
Yeah. It's good. Way to clarify. If I was in Jerome Powell's seat as the Fed chairperson, the only thing that would give you credibility and the only reason why I would buy your book way down the line is if you showed leadership, man. I mean, you were doing the one thing that you can do, increasing rates. Great tool. Keep doing it.
Well,
but just don't.
Maybe not.
Yeah, keep doing it to the point to where you say, okay, guys, we've increased rates. So if they do another 50 basis points, which is probably not, let's call it 75.
Yeah, there's no way they don't just run.
So you're sitting at 4.5% to 5% on the Fed funds rate, which is astronomically high relative to what we've seen over the last 13 years. Not astronomically high from a historical standpoint, but you can say we've raised rates faster than we've ever done in the history. We've done a hell of a job of using the one tool that we have to affect demand. However, we know that there's this thing called a lag effect. I would rather us not. I don't want to be the guy rooting for people to lose their job.
Yeah.
Right? I do not want to do that. That may be a consequence of getting inflation back under control, but I don't want to be the guy that's rooting for people to lose their job in this country. So I want to see how the actual impact of these historical rates actually have on the market. And by the way, just to be clear with everyone, if we can't get inflation going in the direction that we'd like to see in a relatively reasonable period of time here to start 2023.
Like 2 quarters?
Definitely within 2 quarters. You don't even maybe need that much time.
Yeah.
A quarter.
Then
we'll have to, we will have to continue to increase interest rates because that's the one tool that we have. However, my friend right here, from a Congress White House perspective, they can help on the supply side. And they have some things to say about that. Like that would change sentiment. Like sentiment is the worst we've ever seen it since they've been tracking sentiment data.
Oh yeah.
Right. That's a good thing. I get excited when I see that because on the contrarian side of that, eventually we get out of the bear market scenario that we're in and the market takes off in a massive way. We've seen that time and time again. I shouldn't need to prove that. Go look at charts from any bear market that you've ever seen and you'll see exactly what I'm talking about. That is, in fact, what would change sentiment for global investors. And it's the right thing to do. Like you're working government entity with agnostic government position in tandem, supply and demand, right? We're all looking at the Fed and saying, why can't you fix this? Or the White House is saying, hey, OPEC, why can't you fix this? Right, why not just say, hey, why don't we fix this? Because we have the resources, tools, talent to do that. That's my point. And I hope I've aired out enough grievances here for one particular podcast.
Write-in candidate Joshua Garland. Next to list.
So I don't know. I'm not a political guy. I never want to run for political office. It's not something that would make me excited to be in either one of those individuals' shoes. But if you want to look back on your career and say, I had a defining moment when the country was going through a very difficult time dealing with issues, not just here in the United States, but around the globe, they're very, very similar. You can now look at the United States and say, hey, we put all the BS aside from a political standpoint, and we did what was right and working side by side to help control demand and impact inflation. And it didn't happen overnight. Took however many years, quarters that it took to actually do all that, but it was the right thing to do. That would set the right tone and the right message for the global economy, not just here for the United States, individual stock investors. So I hope that I made my point clear. I feel a little bit less burdened by all this information that's been kicked around in my head over the last, 12 hours or so.
I'm glad it was a quasi-catharsis for you. I'm terrified, so I'm going to go to Waffle House.
Terrified is not the right answer. That is not what we're going for here. But I do want everybody to know that this is what happened. That's why they're doing what they're doing. There is a way to solve for that. Unfortunately, as the individual investor, we have zero control over any of those things. We can go vote, right? That's about all the say that we get in that kind of stuff. But the two things that you can control that we've talked about from the beginning of time here on the show is you can control your asset allocation, that percentage of money invested in stocks, bonds, and cash. We talked about what we're doing here and why we're doing it that way. And you can also control your sentiment, your mentality about your own portfolio. And the only way that I can go about controlling, my temperament, my mental state as it relates to investing is by looking at what history has to say under similar circumstances. And under midterm election years, going into the midterm election, markets are generally down. On average, they're down about 17%.
Yeah.
We're not too far away from that from a historical standpoint.
Episode 1 of season 2 of the Financial Shepherd podcast talks about all the historical data for that.
Exactly. We've already covered all this stuff.
Yeah.
So now that I know that, even though we're going through some hellacious times right now because of supply and demand problems and Fed increasing interest rates and nobody's helping out on the supply side, I can control my allocation. We talked about that, and based on what history has to say after midterm election years, now I can start to prepare accordingly for myself and my clients to benefit from the next bull market, because this is not, the new normal. Nobody should be expecting to wake up and every day the market's down, or every year the market is down 20%, and we got all these other freaking problems. That's not what the new normal is. This is a period of time that's not fun to live through as an investor. I think that there are actual tangible things that people can do to not have the whole freaking world feel like, this is going to be the end of days. But I am just one man sitting here in Florence, Kentucky on a microphone on a, Thursday morning, just sharing with you my thoughts of what happened, why it happened, how you can prepare for it, and giving you my take on, a true solution that I think would actually make a major impact and really change people's perspective about politicians and the way that they work together, or for this matter, lack of working together. So I hope that's helpful. I really do. And I really appreciate the questions too. So keep sending them our way. We'll do a happy hour tomorrow. Happy hours, we try to do that on Fridays right around 4:15 after the market closes. We're not perfect on doing them every single Friday because of logistical things, or if Ezra's not here and I can't turn on the camera right, which has happened before. But tomorrow we'll be doing that 4:15, and we'll wrap up what happened this week, why it happened, what to look forward to next week. And of course, keep sending the questions, 513-630-2664. You can also go to shepherdwm.com. There's a whole bunch of information about myself, my background. It'll also take you to our YouTube channel where you can catch any of our previous podcast shows, happy hours.
Yep.
There's also a link to Spotify, which you can download the Audible version while you're driving around, and you can catch the episodes. And please subscribe. That way when we do these shows, it goes on YouTube, Spotify, you get a little alert, and you can go check those things out. So as any parting words for the audience here today, now that I've gotten all these these grievances off my shoulders?
I just want to say, I feel you. I'm right there with you. And as far as the YouTube channel and podcast goes, totally check us out. We move our broadcasting format to YouTube Live on the happy hour. So if you're able to catch it, you can throw in questions live right there. And for anybody who catches the podcast or the YouTube Live on archive, if you have any questions after watching those episodes, just leave a little comment in the comment section, and Josh will get there and answer your questions post-hence.
Yes. So thank you all very much. It's been a great show. I feel a lot better, at least a little bit better. So I appreciate you hanging in there with me. And we'll do this again tomorrow for our happy hour. And I hope you guys have a great rest of your week, and enjoy the weekend that's coming up. Take care.